Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, February 26, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? We have a lot of stuff on the docket. You see a trend line above. We're going to talk about that. Here's a second day from making a top where the market ended up down. Now, we're in the midst of an uptrend / melt up operation. So as you can see from before, market goes up, pulls back a little bit, goes up, pulls back, goes up, pulls back. That's the theme in an uptrend. They go up, they pull back shallow. They stay above the moving averages. The moving averages are creeping upward from lower left to upper right. This is the definition of an uptrend. You have parallel spacing between the 20 and the 50 period moving average. Another sign of an uptrend. Now that can change if the market comes down, but we take it right now at face value. The trend is your friend until she throws your shit out the window, until the trend changes. Now, of course, we know that trends change, they morph from shorter time frames onto longer time frames. We're watching the intraday. That's a big part of what we do here from a live room perspective. So let's say we're going to have a little bit more of a pullback. Where's the next logical place that the market would A, want to pay a visit to, B, would be magnetic, C, would be garden variety of chart support, at least from an intraday perspective? Where is that place and why? Let's do a little chart lesson. Fire up your sticky notes. You see a horizontal line coming across the screen. 503.50 is the blue horizontal line. Why does that represent the most recent breakout area? Because, very simply, we do this all the time, and it's worth a discussion each and every time. Why is that? Here's why. The market runs up to this place. That's the market's way of telling you that place is important, because after it ran up to that place, it had a pullback. Doesn't matter how much of a pullback, was it shallow. The point is, it ran up to a place and found what we call overhead resistance. There was a pullback. Now, the market continued higher, and therefore, when she eclipsed 503.50, that immediately became, by definition, the last breakout area. It's the most recent number the market broke out above on the way up during the uptrend. It's most recent, therefore, on the way back down, we would expect A, it to be magnetic. They should run a test of it. And C, at least from an intraday perspective, it should be garden variety of chart support. You can see it also on the hourly chart. There is your most recent breakout area above 503.50. She gapped above it over here. This was on the 22nd, Thursday the 22nd of February last week. Went up for another day into Friday, and here we are back down on Monday, not necessarily at that price, but if she comes into that price, for example, tomorrow, you can bet your bottom dollar I'm going to have something to say about it from a live room intraday perspective. What if? We always do the what ifs. So we're prepared. It's in the spirit of being prepared for what Mrs. Market throws at you in the morning. What if they're killing the tape? What if they gap down below, underneath 503.50? That's a negative sign. It puts the market basically in no man's land. Officially, this low is 503.02. Open below 503.02. You have one more breakout area here, but there's a lot of no man's land all the way down to 497 and change. We don't know what's going to happen tomorrow. I'm giving you the what if just in case. You never know what you're going to wake up to each and every day in the market. Let's look at the flip side. Let's just say, for argument's sake, the market comes down, whether it's tomorrow into Wednesday, doesn't matter. It finds support somewhere either around 403.50, maybe a little lower. Maybe they even fill this gap. Maybe they run another test of the 20-period moving average. And the what if is this. If they go back up, what does that trend line represent? We should know about that. Where does it come from? Why is it on the chart? Sticky notes, please. Here's a monthly chart. We're going to look long-term at this one. It comes from where? How about March of 2000, almost 25 years ago, 24 years ago next month. That was a big-time high in the market leading up to the dot-com bubble that burst March of 2000. We had an 18-month to 20-month, whatever it was, bear market into October, November of 2002. And what you'll see is that now connects the high that was made in January of 2022 at 479.98. And here we are again as you extend that line through. The high so far is 510.13. This line comes in just a bit higher. The numbers that I put the trend line on are dead on balls accurate. So when you see the line up here, it is in fact, for example, tomorrow morning, it'll come in at around 511.65, 511.70, right up in that neighborhood. Another what if just in caser. That line will be overhead resistance. What's going on inside the numbers today was really, really quiet today. The market was basically in the summer doldrums at the end of February. None of these numbers really got hit today, not the upper ones, not the lower one here at 503 or 505.35. Let's see what else we have as the day gets underway. Same stuff, reiterating the numbers. 507 pops up when the market's open. It's a slower tape. Now that we know how they open, we get to gauge the velocity of the market. We see the participation. We see what's going on under the covers. We can see the makeup of the market. Therefore, I'm happy to put on the board 507, give or take, should be some short-term support where they can bounce the tape. Right of the vertical is today's activity. 5-minute SPY chart. 507 is the horizontal blue trend line, the upper one. We work with a give or take system. I give you the numbers. Sometimes they come up slightly short. Other times they spike them through. The low here was 507.03, I believe. And the low here was by 1 penny less, 507.02. We call that a spike the low and rip it back up in the other direction. We had participants for certain in the live room. We had a whole list of traders that at least got a base hit, which is the minimum requirement. They gave you a little bit more than the base hit. They went up to about 9 points, 507.90, give or take, 85.90. And they floated around kind of downward for the rest of the session. One more crack at 507, another bounce for a base hit. And then they leaked for the remainder of the day, never getting to the ultimate objective today of 505.35. What I urge you to do is pause the video, read the notes, go back to the chart to double check the work. Staying above 507 is the bull case for a bounce back toward the flat line. They did that. They bounced back toward the flat line. Again, pause them, read them, double check the work. Provided the entire afternoon schematic, and the market just floated around, kind of leaked around for the remainder of the day. Nothing doing this Monday. Will they come down farther into Tuesday? They may. Remember, tomorrow is Turnaround Tuesday. My expectation is they have some more work to do on the downside. I think they have some numbers to satisfy on the downside. Therefore, minimum is going to be on the board again tomorrow if they're opening above it, 503.35. We have 503.50. First number, not 503, 505.35, and then 503.50. You'll see tomorrow from an inside the numbers and a live room perspective, that's likely to be some kind of an important zone. All depends on where they open the tape. If they open below that stuff, that's going to be the weaker situation. What's going on over in Camp IWM? They're above all the moving averages. The trend is up for now. They were positive relative strength. We had a couple of relative weakness days last week. Today they had relative strength. They filled this gap today. Were not necessarily rejected, but certainly it was overhead resistance. They found resistance at the gap, fluttered around. They're making a bearish wedge, but they're above all the moving averages. The trend, above all the moving averages, the trend is not necessarily only your friend, but it is the dominant thing. Another opportunity last week, this is the weekly chart, to get rejected. They're right back up. You can see here you have a channel, if you want to call it a channel. It's a bullish, choppy, something patternish kind of thing. But when you look at this, you could say, hey, look, as long as they stay in this channel, there's an opportunity to break out or break down. They're headed for the top of the channel, so we're going to watch for the breakout. If they start to break out, I do have another number above. You see it on the board. It's 216. They're not going to do it the next day, but 216 would get, as they say in the trading parlance, lit up like a Christmas tree. What's going on with the folks down at the transportation department? They were down a little bit more than the spiders today, a couple of tenths of a percent, so it's not really anything of a revelation. We're not going to call it relative weakness. We're just going to call it a down day. They're above all the moving averages. They're kind of hovering on the 20-period moving average, which isn't that important anymore. Neither is the 50 because they've been back and forth through these moving averages. But the concept of being above all the moving averages from a big picture perspective is the trend is your friend. You revert over to the weekly and say, hey, look, they're comfortably above all the moving averages. They're eating time off the clock, building energy to challenge what? A, they have some unfinished business up here at 16,320. That was just missed. And the fact that they just missed it, and if they come all the way back up, they're likely not coming back just to complete that, but to go even higher and begin to challenge these highs over here from July of last year, last summer's highs. For now, if they stay contained underneath 16,050, that's going to be the less bullish case. Break above 16,050, and it opens the door for another run higher. Sticky note material. What about the Q people? Down 23 cents today. We're not going to make a federal case out of that. They're above all the moving averages. They came down a little bit on Friday, came down 23 cents today. Again, they're eating time off the clock. 23 cents isn't a down day. It's a rounding error in the Qs. It's $436. We're going to keep it simple. We're going to kiss it and say she was down 23 cents. There's no change in the Qs eating time off the clock around the all-time highs made last week. You could see the weekly chart. You could make a case they're just eating time off the clock in a bullish, flaggish formation on the weekly chart. There is a case for that. That doesn't mean they can't come down a little bit this week, but there is a case for what they're doing. How about the XLF? We talked about 4010. They hit 4010 last week. The next number is 4080. They got almost halfway in between, a little more than halfway, and they're back down at what? 4010, give or take. 4010 is important. Start closing below 4010, and they're going to start heading back down to, what is this, Thursday's low, and then they fill the gap down here. The moving average will be creeping up. There's still a lot of support in here, but they can certainly come back down a little bit to work off some of the quote-unquote fake overbought condition. What about Smashmouth? Anything wrong here? No, up $1.73. Nvidia's running. You still have the semis running. All-time highs. Above all the moving averages. They're just a little bit far from home base. That's why they stalled out on Friday, stalled out today. Doesn't mean over time, over the next few days, they can still creep higher as the moving averages creep up along with price. That's the way it works. There's no material change from last week. We got a phony GDP this week. That could certainly move the tape. We'll see how that pans out. We have turnaround Tuesday tomorrow. Could get a both direction tape, maybe a flush in the morning and a mid-afternoon or midday, mid-morning maybe, turnaround for the turnaround Tuesday. Awareness, those things do happen. Check in at the Fab 7, Amazon 176.85. They almost got there. They didn't quite get there. That's still my target. No change with that. Above all the moving averages, trend is your friend, target is active. Something's wrong in Apollonian land. Daily chart below all the moving averages. Trend is comfortably down. Let's revert to the weekly. What do we have? They're teetering on the 50-week moving average. This doesn't look like the spiders. So when you look at the daily chart, we had this discussion in the live room today. We're going to do it again in here. Take a look at the spiders and you say, hey, look, this is in a perpetual uptrend. Forget about this down day. It doesn't matter. It's just up, 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 up. And you look at Apple, not participating in the overall broader market rally. Why is that? It's an isolated problem to Apple itself. The chart is saying, no dice, there's something else going on. So we get a comment in the room, and this is definitely worth discussing because the prevailing wisdom, and I know the media talks about this, the talking heads on TV, they'll say something like, depending on the given day, Apple is pulling the market up or Apple is dragging the market down, one way or the other. And on that day, you look at that, you hear that comment, you believe what you hear, and you say, hey, look, that makes sense. Apple is dragging the market down, or Apple is pulling the market up. Apple is leading the market. But then you look at this chart and you say, well, how could that be? How could Apple be pulling the market down today, for example? That's what we were discussing. When the market was up all that time leading up into, for example, last week, last Friday, market's up and Apple wasn't up. So how come Apple wasn't pulling the market up or down on those days? Because it wasn't. Each chart trades independent of one another. It's a lesson I give in detail in the course, Lazy E-mini Trader. I take the symbols off the chart, I take the time frames off the chart, and I prove that each and every chart is independent of one another. And what I do also is prove that all charts act and react the same way. Microsoft, what do we have here? We have a lower high. So Amazon's heading for a target. Apple looks terrible in comparison to the broader market. Microsoft put in a lower high. It's interesting. So far, we're 1 for 3 in the bull case. Let's make it 1 for 4 when you look over at Google. What's going on there? Nothing good with Google. We made plenty of money in Google from a swing trade perspective. That trade is over. So 1 for 4 when you look at Amazon, Apple, Microsoft, Google. These are the Fab 7, or at least part of them. These are the biggest, baddest stocks in the market, and they can't live on NVIDIA alone. We can make a case that's a top in NVIDIA when you look at the daily chart, but when you look at the weekly chart, I can make a case that's a bottom last week. Which one is it? We don't know yet, but what we do know is that this is unsustainable. This is almost vertical. It's called parabolic. These moves get retraced. How much are they going to retrace it and when? We'll worry about it later. This doesn't last forever. Even if it does go higher first, these generally end, as they say in the trading parlance, badly. So far, we're 2 for 5. Now we look at Meta. Go over to the daily chart. Nothing wrong with Meta, just going sideways after the latest gap higher opening after the earnings call. So they're hovering underneath 500, building energy to make another move higher. We're 3 for 6. And Tesla's on a recovery campaign from finding a low at 175.05, pretty much on the button. Funny how that works. We have a target from an inverse head and shoulders formation, even though they negated it from an official standpoint on Friday, but the target would still be the gap. And above this high, the target becomes the gap anyway. So we'll leave the gap as a target on the table if they get above this high from last week. That's Friday the 16th. That's a week and a half ago, or a week and a day ago. Above that high, which is exactly 203.17, opens the door for the gap. That comes in at 207.83, and that doesn't have to be the end. That's just the target. If I told you how much I appreciate each and every one of you, without you, these videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.